Hello everyone, hope you all are doing well. So AAA students, today we are going to discuss the implication of IFRS 18, which is a new standard. Previously, we followed IAS 1 presentation of financial statement, but now the new standard is IFRS 18, which replaced IAS 1. So today we are going to discuss and cover how IFRS 18 can be tested in your exam. As we all know, whenever new thing comes, the examiner might be interested in testing this new area. So there is a possibility that this standard can be tested in your exam. Most probably, if it will be tested, then your question number one, audit risk and risk of material misstatement along with audit procedures, or may be tested in question number three, matters to be considered at completion of the audit or audit evidence and additional information. If you watch my block 3 lectures on audit risk, risk of material misstatement, audit procedures, audit evidence, then you are much familiar with these type of questions. Also, we have started the past paper series. If any student have not watched that past paper series, then maybe you may face difficulty in today's lecture because the sequence and the pattern will not be discussed in today's lecture as we have been discussed so many times in the previous lecture. In today's lecture, I will just give you an overview how IFRS 18 can be tested in the AAA exam. Okay, Topic 7, IFRS 18, Risk of Material Misstatement and Audit Risk. Eventually, the topic name is IFRS 18 as risk assessment means how IFRS 18 can be tested in the question number 1 and question number 3. Significance level, very important for your exam. New standard IFRS 18 can be tested in question number 1, most probably, and might be in question number 3 as well. But after this lecture, you may not face difficulty if this standard came in your exam. Type of risk assessment techniques. Risk of material misstatement equal to inherent risk, control risk. Inherent risk means such as estimates, judgment, the nature of it is difficult to mitigate this risk. Why? Because it's in the nature of that specific component or area. Control risk means if there is a weak internal control in the organization. Let's say there is only one accountant who is receiving payment and doing all the bookkeeping and all the record maintaining. What is audit risk? Audit risk equal to risk of material misstatement multiplied by detection risk. Detection risk. Let's say audit team does not perform the sufficient appropriate audit procedure and does not able to obtain the SAAE. Also, there is a less sample size. So these are the factors due to which detection risk can be occurred. Business risk, factors affecting the company's business such as liquidity issues, going concern, fines, penalty, supply chain, reputation, goodwill, and so on. These are all the factors which we have covered in the block 3 lecture number 2. Sorry. Now, audit risk and risk of material misstatement, these are the definitions which you should have studied as I have covered in the previous lecture. Now, today we are going to discuss how IFRS 18 can be tested. I have just explained you that this standard replaces IAS 1. So there is nothing new, no need to worry at all. There is just a classification. If you remember the statement of cash flow in which we divided the activities into three parts: operating activities, financing activities, and investing activities. So just like that, now in this standard IFRS 18 RPNL will be divided in these components. Let's study IFRS 18 presentation and disclosure in financial statement. Effective date 1st Jan 27. Early adoption permitted replaces IAS 1 presentation of financial statement. Now, purpose of IFRS 18 to improve transparency, consistency, and comparability in the presentation of financial statements, especially the statement of profit or loss P&L. to address investors, shareholders, stakeholders concerns about companies using non-GAAP subtotals like EBITDA, earning before interest, tax, depreciation, and amortization. Operating profit before exceptional items. Remember, non-recurring items, exceptional items, one-off events, anomalies, etc. Structure of IFRS 18, what's new? Specified subtotals in the statement of profit or loss. IFRS 18 requires new subtotals to be presented in a consistent way. Operating profit, profit before financing and income taxes. Profit before income taxes. AAA implication. These required subtotals allow better audit traceability of management performance presentation. Misclassification can give rise to audit risk, especially management bias or window dressing. You are much familiar with all these terminologies because in the previous topics and the previous past paper discussions, we have solved these kind of terminologies. So no need to worry. Categories in profit or loss. Transactions are to be classified into 5 defined categories. In the complete IFRS 18, there is a common word which is classification. So you have to be skeptical that in the IFRS 18, there is a high risk of misclassification. Category and examples. Operating revenue, cost of sales, admin expenses. Investing income, expenses from associates, investment property gains. Financing interest expense, lease liabilities. Income taxes, current and deferred tax, discontinued operations, results from disposal of operations. Means you are going to dispose the complete segment, complete operation. AAA exam tip: if management misclassifies, again misclassification. If management misclassifies finance cost into operating to inflate the operating profit, this may lead to material misstatement, raise a significant audit risk. Management defined performance measures, MPMs, management performance measures. Companies must disclose MPMs used outside of IFRS, such as EBITDA. Reconcile MPMs to most comparable IFRS subtotal operating profit. Provide explanations and comparative means prior figures, last year figures. Audit concern: there is a risk of MPM manipulation. Whenever there is a manipulation, you have to be skeptical to mislead stakeholders such as users. Auditor must evaluate appropriateness, consistency, and disclosure. 4. Enhanced disclosure requirements. Disclosure of unusual income and expenses is encouraged but not mandatory. Clear disaggregation guidance for line items. Example, separating depreciation from cost of sales. Nature versus function. Entities must choose one method and provide disaggregation. AAA risk. If unusual items, anomalies are not disclosed transparently, this may lead to a fraud risk indicators. Auditor must review board minutes, post-air and events, etc. Now, IFRS 18 versus IAS 1 key disclosure. Feature IAS 1 IFRS 18. Subtotals in profit and loss not defined, now mandatory subtotals. MPM disclosure not required, mandatory reconciliation and disclosures. Categories in P&L, no categorization previously, but now 5 defined categories we have covered above. Unusual income / expense not addressed, encourage disclosure. Operating profit optional, mandatory subtotal. Now, AAA focus area with examples. Example number 1, classification risk. Scenario: finance costs are shown under operating expenses to improve operating profit margin. Audit risk: misclassification, material misstatement in key performance indicators. KPIs. Remember, Review of prospective financial information topic, block 4, lecture number 4. Response: auditor should review the accounting policies and test consistency with IFRS categorization. Example number 2, management performance measures, MPMs. Company reports adjusted EBITDA excluding recurring staff bonuses as an MPM. Risk: MPM is misleading, lacks faithful representation. Response: auditor evaluates whether the MPM reconciles properly with IFRS defined subtotals. What are the subtotals we have covered above? And if the adjustments are justified and consistent. Example number 3, operating versus investing income. Scenario: gain on disposal of investment property IAS 40 are classified under operating income. Now, can anyone tell me, is this correct or not? Of course, you just saw because risk is there. Risk: incorrect categorization overstates core operating performance. This is not the operating, this is the investing. Response: auditor checks that investment returns are categorized as investing under IFRS 18. Investment property is for the earning rentals or for the capital appreciation. So these are the investment. You can understand by the word investment. Investment comes or go under the investing activity. Sorry. Example number 4, inconsistency across years. Scenario: company changes definition of its MPM from previous year. Risk: lack of comparability, no comparison, and potential fraud risk if aim is to mislead the users. Response: auditor must verify the rationale and disclosure for such changes and obtain management representation. Even though the management representation is the last resort, and we all know representation alone is not a sufficient and appropriate audit evidence. Now, auditor's responsibility under IFRS 18. Please, guys, be attentive. Area of emphasis: evaluate presentation compliance with IFRS categories and subtotals. What are the categories? How many categories are in IFRS? Can anyone tell me, please? If you know, please comment down. Challenge and verify MPMs and reconciliations. Review disclosures for transparency and comparability. Assess risk of bias in unusual income expense presentation. Assess whether the changes are properly disclosed in notes to the accounts and in comparative figures. Means proper disclosures are given in the FS and comparative prior year figures are given. Let's say you are performing the audit of 23. So there must be a comparative of 22 and previous years. Now, there is one important line for you. Whenever there is a word challenge, it doesn't mean you are just go to challenge the management. It means you have to be skeptical. You have to be judgmental. Make sure you are working with due care and diligently. Now, IFRS 18 AAA risk mapping summary. Area of IFRS 18 risk of material misstatement. AAA scenario example, auditor's response. Operating profit mandatory subtotal. Misclassification of non-operating items as operating to inflate core performance. You may change your wording, it's up to you. This is just for your understanding. AAA scenario example, client records investment property gains as operating profit. Of course, misclassification. Inspect nature of item and challenge classification. Refer to IFRS 18 categories. Define performance obligation. Okay, guys. Area of IFRS number 2. Define categories: operating, investing, financing, etc. Earning manipulation by misallocating expenses. Example, finance cost under operating. Interest on lease liabilities incorrectly shown in operating. Perform analytical review and mapping of line items to IFRS 18 categories. Number 3, MPM management performance measures. Bias in performance measures, cherry picking adjustment. Adjusted profit excludes recurring staff costs to present better results. Check MPM reconciliation to IFRS subtotal. Assess rationale and consistency. Lack of MPM reconciliation. Non-compliance with the disclosure, incomplete financial reporting. No reconciliation between adjusted EBITDA and operating profit. Auditor insists on reconciliation disclosure and check for faithful representation. Inconsistent NPMs year on year. Comparability issue. Potential red flag for earning management means there is a high risk of management biasness, earning management, or massaging the figure. Current year's NPM exclude restructuring cost, last year included them. Check reasons for change, obtain written representation, report in audit findings, means misstatements. Misstatement of unusual income expenses, lack of transparency may mislead users, reversal of impairment classified as normal income. Auditor should request separate disclosure and assess if disclosure is fair and adequate. Disaggregation of material line items. Material information may be hidden in aggregated disclosure. Depreciation buried within admin expenses means depreciation is recorded within admin expenses without proper breakdown. Check management disclosures against IFRS 18 disaggregation guidance. Incorrect application of nature function presentation. Misleading classification may distort performance analysis. Company inconsistently mixes nature and function presentation. Evaluate the accounting policy for appropriateness and consistent application. Comparative figures, last year figures restated incorrectly. This is one of the most significant risks. Potential error in transition to IFRS 18, prior year subtotals not aligned with new categorization. Verify transition adjustment means previous adjustment and reconciliation of prior figures. Inadequate board oversight of new IFRS 18 means override of control, governance weakness, risk of poor quality financial reporting, fraudulent financial reporting. No documentation of how new subtotals or MPMs were determined. If the examiner asks you to write an action, then you can write this is a scope limitation. Auditor to review board minutes, policy papers, and audit engagement and engage audit committee. Now, example application case scenario. Client presents an adjusted operating profit that excludes staff restructuring cost, marketing expense for a new product, and foreign exchange losses. Auditor notes these are regular recurring costs, not non-recurring. Okay, it's a recurring cost. Audit risk. Client may be using biased MPMs to show stronger core results, risk of misstatement and lack of faithful representation. Audit response. Challenge the definition and consistency of MPMs. Again, repeating, if there is a challenge, it doesn't mean you should go to the management and challenge it. It means you have to be skeptical. You have to be alert. Verify MPM reconciliations to IFRS defined subtotals. Now, the second most repetitive word in IFRS 18 is subtotals after classification. Communicate concerns with those charged with governance. Consider impact on audit opinion or emphasis of matter paragraph. If any student not watched the lecture number 6 of block 3, then you don't know about the audit opinions and EOMP. Key AAA exam words to use: faithful representation, management bias, window dressing, earning management, material misstatement of classification or disclosure, substance over form, audit risk linked to presentation and disclosure, professional skepticism towards MPNs. Now, examiner's mindset, why they are looking for. The AAA examiner wants to see professional skepticism, awareness of presentation-based fraud, ability to link audit risk to the financial reporting framework, clear, concise communication in audit planning. Question number 1, risk responses and reporting. Question number 3 as well. ACCA AAA IFRS 18 Risk Toolkit Part 1 IFRS 18 Base Planning Question AAA Mock Style. Mock Scenario: you are the audit manager at Tyrex Limited, a listed entity that has early adopted IFRS 18. The draft financial statements for the year ended 30th June 2005 show the following. Operating profit includes a $5 million gain on sale of investment property. Now you just pick it. It should be reported in investing activity. NMPM titled Adjusted Operating Profit excludes 1.5 million restructuring costs, 0.8 million R&D expense. Comparative figures were restated, but no disclosure of the basis or impact has been provided. Now let's read the requirement. Requirement: identify and explain 4 audit risks arising from the adoption of IFRS 18 and recommend appropriate auditor response. 10 marks. Answer plan AAA examiner style. Misclassification of investing activity. Risk: the gain on sale of investment property 5 million is shown within operating profit, which is misleading or overstating as it is an investing item under IFRS 18. Audit response: inspect supporting documents, validate correct classification, and challenge management if treatment inflates operating profit. Means you have to ask the management the reason, the basis of recording the investment property gain under operating activity. Misleading MPN risk management excludes recurring research and development and restructuring costs, which could distort true performance. Audit response: reconcile MPM to required IFRS subtotal. Assess if adjustments are justifiable and consistently applied year on year. Incomplete comparative restatement disclosures. Risk: IFRS 18 requires prior year figures to align with new categories. Absence of disclosures may mislead users. Audit response: request detailed disclosures of impact. Evaluate compliance with transition guidance in IFRS 18. Presentation bias and management override. Changes suggest potential window dressing or management earning. Audit response: apply professional skepticism, discuss with TCWG and impact on audit opinion. Now, this is part 2 AAA cheat sheet, IFRS 18 risk indicators and auditors response. We have covered these in the above slide. So this is for your reading. If you want to identify these indicators in your exam, then you should read it. Otherwise, it's up to you. Now there is one and last important thing. Key phrases to use in exam: faithful representation and comparability we have discussed above. Now, before reading the sample phrase, let's read the part 3, materiality under IFRS 18. Previously, we determined materiality based on PBT. Now, there is a little bit difference. Financial information assumed. These are examples. Revenue 100 million. Now, the important thing to notice is profit before income taxes. Again repeating, profit before income taxes. In the previous IAS 1, we determined materiality based on PBT, profit before taxes. Now it's profit before income taxes, 15 million. Mandatory IFRS 18 subtotal. Total assets 120 million. Now, materiality benchmarks. Benchmark percentage applied materiality value used in scenario. Profit before income taxes 5%. We all know lower end from 5% to 10%. 5% is the lower end, 10% is the upper end. 7,50,000 primarily benchmark for AAA. Revenue 0.5 to 1%. Total assets 1% to 2%. Now, materiality evaluation, item, amount, materiality, and comment. This is for your reading. Now let's read the sample phrase. The gain on sale of investment property 5 million exceeds the planning materiality threshold 750K based on 5% of profit before income taxes. A required subtotal under IFRS 18. Its incorrect classification may materially misstate operating performance, result in a significant audit risk. If management does not correct it, then auditor shall express qualified opinion as the effect is material. So look, there is nothing new. It's just a new standard which replaces IAS 1. So it's all about classification, how you should classify your P&L items. So if any question come on this standard in your exam, the question will be revolved around this slide. We have covered all the aspects which can be tested in the question number 1 and question number 3. So you guys don't need to worry at all. Please be attentive and be motivated. I will try to identify any question on IFRS 18 with respect to AAA. If there is any question not on the ACCA but other professional qualification, then I will try to upload it for you guys. But don't worry, this is a new standard. Examiner will not go into much detail because the examiner already know that this is a new standard and most of the students are not familiar with the deep dive knowledge of this standard. So if you watch this lecture, then be motivated because you will easily able to handle the question if any question come on IFRS 18. Okay guys, this is it for today's lecture. We will meet in another lecture. If you have any question or any queries with respect to previous lectures or this lecture, please contact me anytime. Take care and goodbye.